A warm welcome to the 12th Capital webinar on insurance-linked securities, short ILS, covering casualty risk. Thanks a lot for joining us. The financial industry never stops evaluating new ideas or creating new products. This is clearly also the case in the ILS market. We at 12 are following those trends closely, and whenever we see something interesting and critical for you and for us, we dig deeper. In the upcoming months, we will update you in a series of, we call them Beyond Nat Cat webinars, on the key developments in this market and share our thoughts and insight. Today, my colleagues Urs Ramsayer, CIO of 12, and Marcel Grundy, our head of ILS sourcing, will start and focus on the question, is Casualty ILS a new investment opportunity? My name is Niels Ostenbrink, and I'm today's moderator. While many participants in the market are already familiar with ILS covering natural catastrophes like hurricanes, like floods, like earthquakes, casualty is something new. Can you give us an introduction, explain what makes this market special and why now?
Yes, good morning also from my side, and thank you, Niels, for the introduction. The ILS market has been developing very nicely over the last 20-25 years to a size of almost 100 billion. However, the cat bond/ILS market is heavily biased and focused on natural catastrophes so far. And even within these natural catastrophes, there is a clear overweight and exposition towards what we call the peak perils. And peak perils is US hurricane, California quake, a bit of European windstorm, the Japanese risks. So again, a clear concentration, strong concentration within these perils. Now, casualty, why can this be interesting for investors? Obviously, what we are looking for and what investors are looking for is diversification within ILS. ILS is attractive for investors because it's fundamentally uncorrelated with financial markets. So in the broader context of an asset allocation, it provides a diversification benefit. And having said that, with the current status of the cat bond and ILS market, there is this concentration risk in these peak perils. There are other perils available in the ILS market, for example, life risks. So life ILS, this is a segment which has been there for a number of years, and we're actually planning to launch the fund in the life ILS space. There is also cyber insurance. There's very strong demand from clients for this kind of coverage within the insurance policies and for the insurance industry. And then there is casualty. Casualty is actually one of the largest segments within insurance and reinsurance, but so far activity to transfer these risks to financial markets has been rather limited. If we go to the next slide, then we see the difference between what is potentially possible in casualty ILS versus the existing cat bond peak peril segment in ILS. So the current cat bond ILS market is focused on what we call high severity, low frequency events. This means events happen very rarely, but if they do, drawdowns and the losses are rather big. The advantage of casualty ILS would be that this is the other way around. It's actually low severity and high frequency. So it's a different type of risk. While in the Nat Cat, we call it tail risk. So far out in the tail of the distribution, it is in casualty trend risk. So it's a deviation from a predicted expected trend. Also, the risk matrix is different. In the tail risk, we calculate the risk in terms of expected loss. On casualty, it's rather the loss ratio. So there are always losses. This is the high frequency, but it's important that obviously the losses are smaller than the premium. So that's then expressed in the loss ratio. So basically, the premiums divided by the losses. The risk period is pretty similar, 1 to 4 years, depending on the structures. And we go further details. The returns, as you may know, in cat bonds are around 8 to 10% risk spread. This is above the risk-free rate. In casualty, it's then rather 5 to 10% above the risk-free, but still very attractive in the broader context of the financial market investments. If we go to the next slide, then we see the different sub-business lines within casualty. So we're talking here about motor liability, for example, but also general liability, professional indemnity, product liability, worker compensation. So these are the different sub-segments, and we're going to explain what this is all about in a few minutes. The question here remains, why would insurance and reinsurance companies actually transfer these risks? And the answer is because given the size of the casualty market, it's a very attractive source of capital. It's another tool in the toolbox for insurance companies to access financial markets, to finance growth. And that's one of the main motivations for the sponsors, for the cedents, to consider a transfer to financial market risk, to transfer these risks to the financial markets. From investor point of view, as mentioned, it's uncorrelated to equity, fixed income, commodity, and real estate, and offers a very interesting diversification opportunity, not only within ILS, but in the broader asset allocation. Now, a few words about 12 Capital and our offerings. So we manage about $4.2 billion of assets for our mainly institutional clients. Our largest strategy are cat bonds and private ILS, but we have also an offering in the credit space, subordinated bonds, private debt for insurance companies, also an equity offering. And as I said, we're going to add a life ILS offering later in the year. We do not have an offering for casualty yet. So this is very explorative, what we're doing here. We would like first to get feedback from clients, whether this is of interest, and then depending on the feedback, we may consider a specific casualty offering in the future. With that, I hand over now to my colleague Marcel, and he is going to explain us what casualty ILS is, what the risk and opportunities are.
Thank you, Urs, for handing over. Obviously, if you're looking at casualty risk, I think it's probably fair to differentiate what is the likelihood of casualty risk to be transferred to the capital market. So we would suggest to differentiate between what we would call heavy casualty on the one side and soft casualty on the other side. Heavy casualty, that is liability for certain critical industries. Let's think, for instance, of the oil industry, Deepwater Horizon, caused a lot of liability losses. And soft casualty is more the lines which are based on the law of large number. So general auto liability, general liability, or workers' compensation, where the underlying portfolios comprise 100,000 of risks or policies. So heavy casualty implies a higher tail risk, whereas soft casualty probably would have a lower tail risk. So it's probably fair to say soft casualty might be easier to transfer to the capital market, and that's actually the first efforts of risk transfer to the capital market we see obviously more on the soft casualty side. As said before, casualty is not an event risk as natural perils. It is a trend risk, which is subject to social cost inflation as well as to legal risk. And it's also important to know that casualty is perceived to be more a long-term risk because it may take several years until the ultimate loss ratio stabilizes. So it might take at least 1 year. And it's probably fair to say maybe after 2 or 3 years, you have a certain view on the direction of the loss ratio. The good thing is we have a lot of historic data available for casualty risk. There are tested sound actuarial analytical tools available which help us to analyze the risk. The question raised before is, we've seen obviously the ILS market emerged around 30 years ago. It was really predominantly Nat Cat risk being placed. And the question is, why have there not been any efforts to place casualty risk into the capital market? And we probably have to look a bit back into the history. I mean, casualty risk has a bit of a, let's say, difficult reputation. You might remember, if you're old enough, the liability crisis of the mid-80s, which probably brought the entire US market basically at the brink of collapse. I mean, in the US, you had the award of high punitive damage or indemnification for pain and suffering losses. You had high lawyer fees. And the result was that many of the casualty lines did run with loss ratios far excess of 100%. The largest losses were related, obviously, to asbestos, pollution, and health. And just as a side remark, I mean, there was a famous German reinsurer, Gerling Re, which was at that point in time probably number 5 worldwide. And they, facing the difficulties from the US casualty book, basically went out of the market and ultimately were taken over by the Talanx Group. For investors, I mean, the challenges clearly were the longer tenor of casualty risk, the time it takes to develop the ultimate loss ratio, also a bit different trigger mechanisms. We have here risk attaching or claims-made policies from time to time, and the perceived difficulties to manage the collateral, because obviously you don't want your collateral to be locked up for too long. You want to basically have your collateral matched closely to the exposure and the liabilities, and that really did not create utmost interest from the investor side. And also, banks intermediaries really did not put a lot of effort into the transfer of casualty risk into the capital markets.
Marcel, that is clearly not a very promising history. Nothing new. Why is this popping up now, and why do we have this webinar today? Why is this interesting?
Yeah, I think the interesting point is that right now we're seeing a bit more interest into ILS casualty or transfer of casualty risk into the capital market. And the reason is that we saw in the last probably 2 years a number of insurtech players and platforms coming to the market, trying to facilitate an efficient transfer of casualty risk to the capital market. There are now innovative ways of sourcing, maybe trying to bring the sponsors or the hedging entities of casualty risk closer to the investor side. Obviously, the most important feature, as mentioned before, in casualty risk is the actuarial support. And there are a lot of data, historic data available in casualty risk. And we believe this immense data is probably available to be analyzed via alternative AI powered technologies to analyze really the larger volume of complex data. There is obviously more need for capital motivated reinsurance. Casualty is a premium and reserve intensive business. So there is motivation also from the sponsor side to transfer the risk. And what we're also seeing is that large investors who basically were in the forefront entering into the ILS market maybe 20, 25 years ago are now testing the water with casualty risk as well. Maybe if we come to the next slide, we said when we talked about the different casualty lines, I think it's, and we did look the last couple of years for the US market. The data are based on the National Association of Insurance Commissioners. We see that casualty lines basically have a stable loss ratio. I mean, they are not really big outliers. The loss ratios should be slightly below what you're seeing in the property lines. we think that probably a fair loss ratio to allow for the transfer of casualty risk to the capital market should be in the range of 44-45%. And I would mention one very important aspect here. I mean, what you are seeing if you analyze the NAIC numbers is there is quite a variance in the results. Probably the results between different carriers is, let's say, between 20 and 80%. So the risk selection also in this area is really core.
And how do I invest, Marcel? I think the critical question. We know that cat bond investing is quite normal for especially for us already now. And how does it work in this line of business?
Yeah, in casualty, it's a bit different. And basically, I mean, the underlying structures are always basically transformed into a note, into an investable security, or in a private reinsurance or swap transaction. But we have to look at the underlying reinsurance instrument. And in casualty, we have quota shares and stop loss contracts. Both of these contracts have the underlying loss ratios. In the property, peak peril, the driver or the trigger is an event. Here it's a bit different because, as we heard before, the exposure here is more to the trend risk, basically the trend leading to an exceedance of the anticipated and expected loss ratio over a year. And we have here the chart of a quota share solution. And obviously what yourself as investor ask yourself, how can I invest efficiently with my collateral? I mean, a quota share is a proportional risk sharing, and you have invest initially an amount which is available as the initial collateral. The initial collateral is obviously there to cover the deviation or the downside risk of the loss ratio if the loss ratio exceeds the anticipated amount. And what is important to know here is that the initial collateral as well as the reserves which are transferred within such a transaction are decreasing over the term of the transaction. So usually you have a 1-year risk period, could be this risk attaching or risk occurring. You have the initial collateral and the transfer of the reserves to the reinsurer. And these amounts are gradually reducing. And probably in year 3, 4, you see a certain stabilization of the loss ratio. And that would be exactly the time when you could think about an institutionalized commutation feature, which would allow then, once the loss ratio has stabilized, a termination of this contract. Maybe if you look at the next page where we have tried to basically show the cash flow profile of such a transaction. Again, you see here it's inception of the transaction. You see the initial investment of the investor, which should allow for the initial collateralization. And then basically in year 2, 3, and 4, you are seeing the emergence of the earned premium, meaning the premium after expenses and after losses. The risk premium is increasing year 2 and year 3, then going down in year 4, probably when most of the premium is earned. So probably from year 4 on, there is not much development on the earned premium. And that is exactly the time when the collateral should be substantially reduced. And that is then the time when we should, or the investor should think about an exit of the contract. In reinsurance terms, we are speaking about a commutation. So it is very important that it is not just an abstract opportunity. The facilitators of this transaction have to ensure that there is an efficient market behind these structures to allow for a fair and transparent commutation. And the second structure is the so-called stop loss structure. Again, reference is here the loss ratio. I mean, stop loss is for us clearly a capital management instrument. We have taken here an example which is based on 100% of a casualty book. Stop loss provides for a fixed premium, whereas the quota share is more a variable premium, because with the quota share, the premium really depends on the expenses, the amount of the losses, and the premium amount. In the stop loss, you have a fixed premium, be it 4, 5, 6%. You define a certain risk, a certain attachment level defined as a loss ratio. In our case, we have taken in this example a loss ratio attachment level of 80%. The attachment level is determined by the mean loss ratio, which is in this case was 64%. And then obviously you apply a certain buffer, in this case 15%, which should allow to capture any deviation of the loss ratio beyond, let's say, a normal level. What we are seeing here is that basically the structure incepts at a combined ratio. That means losses plus expenses in excess of 110%, which would be beyond the level what is usually being captured by the equity of the company. So quota share, more the risk sharing part, stop loss as a capital management instrument with a fixed premium. These are the two features available for the transfer of casualty risk, and both features can be captured in a note format.
Marcel, one question I got from our participants. Can casualty also be designed in a parametric way? So very state-of-the-art question.
Yeah, but I think then you're probably going more into the accumulation risk. I mean, you can definitely define casualty risk by a loss amount, for instance. Like you have with the PCS for ILWs, a market loss trigger that can be theoretically applied for casualty. I mean, you have certain large casualty losses as well. I mean, just think liability for the Enron case 20 years ago, Deepwater Horizon, another example. But I think what we are looking here is more, let's say, larger portfolios which are driven by the law of large numbers, not the, in a way, more event-exposed type of casualty risk or the heavy casualty.
Thanks a lot. Yeah, so over to Urs. Urs, what is the outlook now for 12 Capital and the ILS industry? Will casualty become a rising star in the ILS sky, and will 12 Capital adjust its current strategy, which is focusing on Nat Cat peak risk, and add this sector to the ILS offering?
Yes, thank you, Niels. As Marcel mentioned, there are already some larger pension funds which have been in the ILS space for decades now investing already in casualty ILS. So this is happening. We are still evaluating whether this is an opportunity for our client base, and then depending on the feedback, decide to launch eventually an offering in the casualty space. What we probably not do or will not do is add these risks to the traditional ILS portfolios. I think it makes sense to keep this separate. But given the size of the casualty market in insurance, there is clearly big potential for this to develop and to grow significantly. It's very important, as Marcel mentioned, to do this properly, to structure it correctly, to manage collateral releases and also the commutation at the end of the risk period.
So in this aspect, a question from our participants: what is the advantage of investing in such risk instead of Nat Cat, given also the fact that probably the models we have, you mentioned it, right, proper modeling here is critical, that we have better models on the Nat Cat side. So what could be the advantage of having this in a portfolio?
I mean, the advantage clearly is it's uncorrelated with Nat Cat. It's uncorrelated with financial markets, offers similar returns than Nat Cat. So it's a clear diversification potential within ILS. And what is important to say is also that the returns in casualties are much higher than on the diversifying Nat Cat perils. So the risk-adjusted returns for casualties are better than, for example, for Italian earthquake or German flood. So for us, from our perspective, it makes more sense to look at this business line than diversifying within Nat Cat, where we focus rather on the peak perils. So if investors would like to have a broader ILS portfolio, then we would rather recommend to look outside of Nat Cat and not try to diversify within Nat Cat, because the returns there are just too small and not really attractive anymore for financial investors. The focus on Nat Cat is clearly on the peak perils. In terms of modeling, there is a difference because on casualty we have decades of history. We know how the losses are developing. We know how it's going in terms of trend. We should not forget in Nat Cat we don't have history. We don't know what the frequency of the big California earthquake is. This is all based on models, stochastic modeling. Here we have actuarial data, so it's a completely different approach. I would not say that the quality of the models is weaker. It's just a different way to model and to assess the risk.
Thank you. One final question, which is also quite actual. How much inflation effect will we see, or can we probably expect in casualty ILS?
Obviously, I mean, we learned, I mean, casualty is a trend risk. And obviously, I mean, there is inflation, and you see it clearly, for instance, if you look, for instance, at motor indemnity, I mean, there was 22, obviously an increase in the loss ratio, I mean, driven to higher repair cost, for instance. That is clear. Obviously, what you are, let's say, hoping for or relying on is that the insurance companies are able to basically enforce rate increases covering the inflation during the year of the contracts. I mean, insurance companies obviously are reviewing the development of the portfolio, and the inflationary aspect should be obviously captured in the contracts. So meaning that you have a higher premium base or higher gross written premium, basically covering inflation. And if I come back basically to the liability crisis of the 80s, I mean, after the crisis, the insurance companies obviously managed to cope with it. I mean, they obviously brought up restrictions in the scope of coverage. They increased the retention levels. They worked on the exclusion list. I mean, casualty is always a moving, let's say, business. I mean, it's not just as you Cat, you have an event, and if it's big enough and exceeding the retention you're paying, I mean, with the proportional risk sharing and basically the link to the loss ratio, you're obviously more dependent on the proper management of the portfolio of the insurance company. So it's important to know.
Thank you, Marcel. Thank you, Urs. Time is running. So to summarize, we see that this is something very interesting, forward-looking. We would prefer having casualty as a diversifier in an ILS portfolio than probably secondaries, and so as an interesting add-on to our peak peril ILS core strategy. Very interesting. Finally, thanks a lot. I'd like to aware, but before we leave, I'd like to make you aware of two upcoming 12 Capital webinars. On the 13th of June, we will have our 2023 hurricane update, hurricane season update. Questions clearly, will it be like last year? Not a single storm in August, followed by a major hurricane in September? Probably not. Very interesting question this year. What will be the impact of La Nina, El Nino or conditions? One of the key talking points at the moment will be the recent trend toward an El Nino environment. So on the 13th of June. and another one, and this is then the second or the next webinar in the row beyond Nat Cat, which will be mid-July on the 13th, right before the summer break starts. And here we will focus on live ILS. Whenever you have a question about Casualty, about 12 as such, about our cat bond offering, ILS offering, please reach out to us. Finally, thanks a lot for joining us today, and goodbye.